Good afternoon, it's Patrick Armstrong. I'm Chief Investment Officer at Plurimi Wealth and doing another quick podcast on how we're investing given the biggest issue in markets in the world right now, the war in Ukraine. I'm discussing a little bit on our positioning, what's happened year to date, and what we expect to be the consequences of this in the short term and in the long term. Unsurprisingly, all of you will be aware who've looked at your portfolio statements this year, the markets are down. It's not even equities that are down. MSCI World is down 12% year to date. Corporate bonds are down 10% year to date. So it's not been an easy investment backdrop for long-only managers who buy equities or who buy bonds and allocate back and forth between them. We've done quite well in our strategies that we have more flexible mandates. We allocate to commodities, so gold has done very well, silver has done very well in most of our discretionary strategies this year as well. And the natural resources bent of our equity positions have really led to good returns for our strategies, where our cautious strategy is down 3% year to date, and our long short strategy is actually flat and up in sterling terms. So if you've just bought passive exposure to equities or bonds, it's been a very difficult backdrop. It's been a challenging backdrop no matter how you've been investing. But with the war, I think the consequences right now are higher risk aversion, which means lower market prices. But it's not just short-term basically issues that are going to result from this war. There's trends that have already been in place, and this war has just probably pushed these trends forward and made them much bigger than they would have been otherwise. Since 1985, the world has benefited from a disinflationary backdrop that's been very pro-growth. Globalization, peace, free movement of labor, free trade. Companies have gone to just-in-time inventory management. All of these things improve profitability, reduce costs, and consumers benefited from goods being produced more cheaply, and they could buy them more cheaply. Companies benefited from higher profit margins. And it allowed monetary policy to be incredibly accommodative. Massive amounts of liquidity pushed into the markets. It pushed up asset prices, but not goods prices. And what we've seen over recent years is a swing away from globalization towards protectionism, towards populism. The war has created sanctions. Countries and companies realize they need strategic reserves of assets. So it's going to provoke hoarding behavior. And this is a complete change to the disinflationary forces of globalization. This is a stagflationary backdrop, and that's what you see in the year-to-date performance of asset prices. You see bonds going down at the same time as equities. Stagflation is toxic for traditional assets, and this isn't something that's going to go away quickly. This is something that was already in place before the war in Ukraine. You saw it with Brexit. You saw it with the election of Trump and populism, building walls. These forces are in place, and you should be investing with this as a backdrop. It's not something that's going to go away when the war ends. This is something you have to consider. And what it means is higher yields, stickier inflation, higher prices, lower equity multiples. And it's not an easy backdrop, but it's not insurmountable either. You should be allocating towards shorter duration bonds that offer a yield above inflation. You should be allocating to equities that are trading at multiples below historic equity averages with shorter duration, companies that are producing cash flow today, not cash flow 10 years from now. It's not going to be a market environment that rewards blue sky thinking for dream stocks that don't have profits yet, but one day, decades from now, maybe they will. That was the investment strategy for 2020. For 2022, look for companies that own resources and assets that are in short supply. Sanctions are going to mean commodities, short supply. Demand is probably going to remain robust as hoarding behavior is almost inevitable. Countries will want to build up strategic reserves of oil. I think there's going to be a tailwind towards nuclear as countries move away from Russian oil and Russian gas, things like that. So our positioning is owning commodities, owning companies that have massive cash flows right now. Shipping companies continue to trade at 4 and 5 times earnings. They have incredible pricing power. And I think this is the strategy, not just for the day, but it's a strategy for the coming years. Look for short duration, highly cash flow generative companies, avoid the most expensive equities. So that's my 3-minute summary on a very big picture issue, but if you want any more details, feel free to contact your relationship manager. Bye-bye.